All right, today I'm going to talk about the 3 biggest myths in income investing. If you've been around investing forums, Reddit, or even YouTube comments, you've probably heard the following. Return of capital is just giving your own money back. NAV erosion means the fund is dying. Higher the yield, higher the returns. For me, these are 3 of the biggest myths in income investing. I'll walk you through how I see them, show you real-world examples from funds that I follow and I like QQQI and ULTY, and wrap up with the one metric I care about the most. So make sure you stay till the end when I reveal that metric. Welcome back all. Rico here. So like I said earlier, I've gotten a ton of these comments already. Most people talk about return of capital and NAV erosion, which is fair, but let's talk more about it. And before we do that, this is for educational and inspirational purposes only. It's not investing advice. I'm simply sharing how I personally evaluate these metrics and how they fit into my own portfolio strategy. So, myth number 1, the return of capital payback myth. So first, let's talk about what is return of capital, or ROC. So return of capital is when part of a distribution is classified as returning some of my original investment, not dividends or interest income. It's a tax classification, so it's not always an automatic red flag. And here's another way you can think about how I think about ROC. It's like a vacation fund that I contribute to every month. And when it's time for a trip, I have money set aside. No scrambling for funds, no extra taxes, no overtime, none of that. And then after the trip, I start adding money back into it. And if that fund keeps getting replenished, it works beautifully. But if I only ever withdraw and never add back, it eventually runs out. And the only time I'd really get taxed is if I withdrew that money and used it for something other than a vacation. See how that works? So hopefully that analogy helps you. Here it is in practice. So for funds like QQQI and ULTY, return of capital is often intentional, and they use a 60-40 tax strategy where 60% deferred capital gains and then 40% is taxed as ordinary income. And they also use tax loss harvesting to deliver tax efficient monthly income. So that 60% deferred capital gains is only a taxable event when I sell the shares. It's not when I receive the distributions. So for the year, I'm effectively only being taxed 40% as the ordinary income from my distributions. So I love that strategy. So here's another example. The most recent ULTY distribution was 59.24% return of capital and 40.76% income. And that is a mix that can reduce your current year tax liability for as long as I hold those stocks. So let's look at when ROC is actually positive for me. So for one, when it's intentional and tax efficient design of the ETF. Like I talked about QQQI and ULTY, they do it on purpose. I also like ROC when it helps smooth income without selling shares. So I don't have to sell my shares to actually make money. And then if it's backed by sustainable sources like option premiums, aka covered calls or puts. When it's a red flag though, is when you have high return of capital plus falling NAV, which we'll talk about later, a dropping share price, and shrinking distribution amounts, not yield, but amounts. That is when you need to be highly cautious and diligent. And this will typically happen in a bear market or a downturn. Liberation Day is a good example of a minor and quick downturn that had a relatively quick recovery. Moving on to myth number 2, NAV erosion. So let's talk about what it is. So NAV is net asset value, and it's the per share value of a fund's holdings. The best way to express it is taking the net assets and then divide that by the outstanding shares. And so as you can see here with QQQI, their data, if you take 3.8 million or 3.8 billion, roughly, which is their net asset value, and then you divide that by the 70 million or so shares, you get $53.85, which is the actual share price as of the date of this recording. So it's trading at a fair price because the NAV equals the price. Now, a falling NAV isn't always bad. Sometimes it's by design for income first strategies. Think about it this way. Think about NAV as like the water level in a water tank. In a healthy strategy, I open the tap each month to get income, and then the rain, which comes later, which is market gains and option income, will refill the tank. And if the rain stops, but I keep taking income or draining the water, then the tank will eventually run dry, and that's when you start to get to like almost zero, right? So this is how I see it in practical terms. So both QQQI and ULTY are great examples. So their share prices have been relatively steady, like in terms of ULTY, or trending up, like in terms of QQQI, while trading right around their NAV, like we talked about earlier. This shows me that they're maintaining their underlying value. And I keep my eye on price, but also look at if they're trading at a discount or trading at a premium. So a discount means it's trading for under the net asset value. So if the value was $53, but it's trading at 52, you're getting it at a discount. And a premium means it's trading for over the net asset value. So if it's worth that $53, but the price is 54, it's trading at a premium. So here's when I'm comfortable with NAV erosion. So if it's slight and they're temporary dips during flat markets, i.e. tariff talks and scares that eventually get pushed out, or recovery during positive market cycles, this just tells me that it can't keep up with the demand, but it should catch up eventually. Or if I'm seeing just a positive total return overall. But when I start to get uncomfortable and anxious is when there's constant net asset value declines with shrinking distributions over a long period of time. And I saw this in many of the yield max ETFs, and particularly the ones I held, MSTY, TSLY, and NVDY. So I exited TSLY and NVDY, and I drastically cut back my holdings in MSTY. Some people may agree, may not agree, but that's what I saw, and for my strategies, that's what I did. Okay, and last but not least, myth number 3, high yield is the way to go. And first, let's talk about what yield actually is. So distribution yield, it measures the annual income payments made to shareholders, and it's usually expressed as a percentage of the current unit price. So in simple terms, it's a way to understand the potential cash flow generated by an investment relative to its cost. So this is probably the worst metric to use if you look at only one metric, because a high yield covered call could be much safer than a high yield individual stock, even if they have the same distribution yield. And we'll get more into that in a bit. Here's another way to think about yield. Imagine a restaurant that's offering 50% off of everything. And it could be for a couple of different reasons. One could be they're celebrating an anniversary and wanting to share that joy and success with their customers, which is the good kind of yield, right? Sharing success. Or another reason might be that the restaurant is trying to fill seats because the food sucks, the roof leaks, all kinds of problems, which is a yield trap. So don't fall for the yield trap. They're just trying to get people in so they can get money and fix all the things that are bad. So don't fall for the yield traps. And here's what it looks like in practice. So covered call ETFs, I love them, and income ETFs often run at a 10 to 15% distribution yield, if not more sometimes. And that's normal for their strategy. They are very upfront about that in their prospectus and all of their documentation. So it's normal. It's part of what they do. It's actually what they shoot to do. Where I apply the restaurant warning is with BDCs, MREITs, REITs, individual stocks, things like that. If I see a plus 10% yield there, I usually take a closer look. Most successful BDCs like Main Street Capital, which is around 6.3% yield, and Hercules Capital, which is on the higher end, which is around a 9.3% yield. They have more modest yields because they're built on sustainable loan portfolios, not collapsing prices and trying to just catch up to everything else. So let me talk about when I'm excited about those bigger yields. So the first is if it's backed by consistent growing cash flow, like things like ADC, things like Realty Income, or Main Street Capital. If it's also safe for me if yield percent moves with the price, but distribution amounts stay steady or they grow. And when it's a red flag for me, it's when yield jumps from a collapsing price, not from stronger payouts. And then if you combine that with NAV erosion and falling distributions, that's when it's a huge red flag. And so remember, you want to look at distribution amounts, not always a percentage. Because if you look at something like ADC or Realty Income, you'll look that they have increased their dividends they've increased their distributions every single year, right? But you look at their distribution yield, it varies depending on the price of the stock. So it's always important to look at the actual distribution amounts and the distribution amount consistency as opposed to just looking at the distribution percentage. Because stock prices change, but distribution amounts shouldn't vary that much. So what do I look for when looking at stock performance? I look at all three of these things and the mystery one that I'll talk about just in a second. And I want to be sure they still look strong and stay out of the danger zone. And for me, the danger zone is when return of capital is high, sometimes to the tune of 100%, NAV is falling, and it's at a discount, and the price is dropping, even a deeper discount, and then those distribution amounts are shrinking. Not necessarily the yield, but the amounts are shrinking. And that's when I know my investment is just handing me back my own money, and that's when I start to either look at market conditions or reallocation. And if the market as a whole is pulling back, then I decide what I want to do. Stay in, buy more at a discount, sell. But if the market is steady or growing, then I might just look at a reallocation, which I recently did with JEPQ. And you can catch that in my other video where I did a side-by-side comparison of JEPQ, GPIQ, and QQQI, and decided that a reallocation was actually in order. So I would be remiss if I didn't tell you about my ultimate metric, the one that you've probably been waiting for. This is probably my most important metric of them all. Again, but I use them all together. There's no myth here, so this is just a bonus metric, and that is total return. So I consider ROC, NAV trends, and yield, but within all that, the metric I care about the most is total return. So I use TradingView and I use Snowball Analytics to track my holdings against other opportunities. And if you'd like a free trial and discount for Snowball Analytics, you can find their link in the description below and use my promo code RICONTheSoul for a discount and a free trial. I'm an affiliate, so if you sign up, I will get a small commission. Just want to be upfront about that, but you can try it for free. I love it. I've been loving it since I've been using it, and it's made my investing journey so much easier and so much better. Okay, so according to Snowball Analytics, my income-focused, six-figure salary generating portfolio is trailing the S&P 500 by less than 2%. And for me, that's a trade I'll make any day for freedom and flexibility that income gives me today. To me, it's priceless. Be home with my kids when they get home. They're young. Like, I can't explain how valuable that is to me. So when I hear ROC is bad, NAV erosion is always bad, or high yield is king, I filter it through my own experience and my own goals. This is my approach, not advice to you, but if it inspires you to look closer at how your investments really work, then it's worth sharing. I would really love to hear your thoughts on these metrics in the comments down below. Let's keep the conversation going, keep it kind. You can see from earlier, like I get it. I get the whole shebang when it comes to perspectives, and I love it. And I love the debate that elicits, and it gives me video ideas like this. And if this was helpful, I would really appreciate it if you could hit the like, subscribe, and share it with someone who might need it. And remember, if it doesn't challenge you, it doesn't change you. Take care, and I'll see you next time. Boom.